Bruce, when you think about this idea that interest rates could stay higher for longer, the reality now that even a summer rate cut is at the flip of a coin, really, how do you think through that uncertainty and how it impacts the way you're investing?
Well, first, the Fed meets next week, and this Sunday is March Madness, and so the March Madness comes next Wednesday will be real because we'll be looking to skew, we'll be looking to mean, the median, where the dots are, 2 or 3, what the Fed does. Powell's been talking about the bump, and the bump isn't really a bump because a bump means it's coming back down, and right now it looks like for the last couple months it just smoothed out and plateauing now, moving sideways at this 3.5% CPI, 3% PPI. So will the Fed move come June? And you're absolutely right, Sonali. I think it's 50-50. And so this higher for longer is real. I think Brian's right. I think your implication of that question that you asked is right, because I think it will be higher for longer and will have a major impact on a bunch of different cohorts in the marketplace.
Let's talk about those cohorts. Of the ones you think that are going to be most drastically impacted, where do you think most of the pain will be?
Well, I think there's 4 cohorts just to define them. So number one is CRE, the top, very top, that's most levered to rates. Number 2, there's companies, and 3, there's banks, and 4th, there's a consumer. So you want to unpack each one, or do you want to
Yeah, let's start actually there with one specific part, because let's start with companies, because
Okay.
you look at the market today and spreads are super tight. You look at the market and you think from high grade to investment grade here, or junk bonds rather, you are looking at people who believe that nothing is going to go wrong in this economy. Do you agree with them?
No, absolutely not. I mean, the IG market is, pretty tight. It's pushing up against all-time tights, and high-yield bond spreads are also very, very tight, and so they're just too tight for the risk, I think, in the marketplace. And I think they are vulnerable. But with these tighter spreads and the easing of financial conditions, maybe not the Fed funds rate, but the easing of financial conditions, it's the year of the refi, and it's going to be like huge, huge volume all year long for IG and high-yield companies. So within that, there's a mix, right? So you have the 90% that will do well. First of all, big companies are going to do very well in this environment because high rates and low financing costs allow them to make a really nice return on their cash. It's the 10% of the tale of 2 cities, that's the other side of the equation, that's struggling. And so take a look at like some of these software buyout companies and healthcare buyout companies and some of the retailers. I just came on just a minute ago, right before I was checking out my emails and going through my inbox. S&P just released a report that I'm going to have my team print out when I get back that shows 29 companies this calendar year already, the fastest pace of defaults since 2009, this calendar year. We don't read about it. We don't talk about it. I recently posted about Invivo, who just filed for bankruptcy, a green company that's not so green, that, blake cash. And so there's lots of companies that are over-levered. Anthology, Quest, 2 big software companies in the buyout space that were supposed to be leveraged 8 to 10 times. Positive EBITDA, didn't grow into their models and for their forecasts, and so are levered about 15 times debt to EBITDA.
It begs the question here, we have not really seen a real distress cycle. And do you think that one is still coming? So
there's $5 trillion of debt between high yield and loans, US and Europe, and we think there's around 400 to 500 billion that will be restructured. So you can say there's no cycle because there hasn't been a recession, but last year was a pretty decent year for distressed and dislocation with about $180 billion that went through restructuring. And this year we think that number going into next year, in the next 2 years, could be 350 billion or double that. So we're calling for 500 billion, and that'll be bigger or just as big as what happened in 2008 and 2009. Maybe not in percentage term, because the markets have grown since then, but in absolute volume terms. And so we're seeing that again in software and retail and in healthcare companies and across industries that are too levered.
It's pretty incredible here. If you think about what you're drawing out, this idea that you'll see more bankruptcies, this idea that more companies may face restructurings, this idea that more of corporate America is now laying off more individuals, do you think that the data can either get much softer for economic data, or do you think that it's masking some of the problems that we're seeing already in the economy?
Well, the masking is coming from the big government spending and those huge deficits that we're running, because a lot of growth is coming from that part of the equation. And corporate America, it's, again, a tale of two cities. You have S&P, which is up 8%. You have, IWM, which is Russell 2000, which is flat on the year. And you have a lot of companies that are levered, that are burning cash just to service debt. Now, if you look at the Moody's report and you look at the B3 rated companies, there's a big cohort, somewhere around 35 to 50% of companies that have to burn cash just to service their debt. So that's the tale of two cities that exists. We see that in CRE as well. We see that with the banks. The big banks are really safe and fortress balance sheets, JP Morgan, Bank of America, Citi, Wells, and the big trust banks like, Northern Trust and State Street and Bank of New York. There are fortress balance sheets, really safe. But there's 4,400 banks in this country, and it's the 90-10 rule. About 10% of those have really high funding costs in the double digits, and in addition to that, have balance sheets which are really troubled because they have about 40 to 50% in real estate. And so we think they're already insolvent or moving towards insolvency, and the industry will continue to consolidate. So it's happening in the banking sector, it's happening in the corporate sector, it's happening in real estate, it's also happening with consumers. We see delinquency rates among consumers for both autos and credit cards having surged from less than 2% to over 6% today in the last 12 months. So you're seeing this tale of two cities play out at these higher rates.
Now, I want to talk about real estate more because you have very divergent views here. You have some people saying that you don't really have a floor yet when it comes to property values, when it comes to commercial real estate more broadly. You have Blackstone saying real estate prices have bottomed and it's an opportunity to buy. On that spectrum, where do you stand?
Well, I stand with, I wouldn't argue with Jonathan Gray, because he's a pretty brilliant guy, and Blackstone has a lot of very good on-ground data, but let me share with you the data that we have. So there's about 21 to 22 trillion of real estate in the market, and a lot of companies own their own real estate, and so they finance it on balance sheet as opposed to putting debt on it. But the $8 trillion of property that is financed with $5.6 trillion of debt, a lot of that is upside down. How much of that is upside down? Well, Barry Sternlicht says it's $1 trillion. We'd actually agree with Barry. We think it's about $1 trillion that's upside down, where the equity is basically depleted, where that $100 million property, $70 million loan is only worth $70 million. And so either the sponsor has to come up with more money to roll that, or they're going to have to flip the keys or lose their property. So here's the punchline, Sonali. So this year, it's a record. And look at that record wall. You have $900 billion of debt coming due this year when there's only supposed to be $540 billion debt coming due this year. Why? Because a lot of those loans, hundreds of billions, got extended and amended or kicked the can down the road into this year because they couldn't refinance. The markets are open, and the big question is, can they refinance? Take that $100 million property, a $70 million loan with no equity left, and it's a Class B or C office building.
Right.
What's the alternative use? It's raising that building, taking it down to land value, which means it's only worth probably 30 cents on the dollar.